All right, buckle up, because it's that time of year again.
Tax season.
Exactly. And it often feels like, I don't know, navigating a dense jungle, right? Especially for anyone running their own show.
Oh, absolutely. Whether it's full-time or that bustling side hustle.
Yeah. Diving into the tax code can feel pretty daunting. But what if we told you there's a shortcut? Not just to feeling confident, but maybe, just maybe, finding every legitimate way to save your hard-earned money.
That's the goal, isn't it?
It really is. Here on the Deep Dive, our mission is simple. We take those stacks of dense instructions, those complex forms, and we pull out the most important nuggets of knowledge.
The surprising facts, the things you might miss.
And those aha moments that make you feel truly well-informed. Today, we're embarking on a crucial deep dive into Schedule C.
Profit or loss from business.
That's the one.
Yeah.
This form is, it's the absolute heart of tax filing for so many self-employed individuals and small business owners.
It really is central for millions of taxpayers.
So our specific mission today is to unpack this form, item by item, focusing laser-like on how you can apply these instructions to maximize your deductions.
And discover those crucial, maybe often overlooked, tax-saving methods.
Okay, let's unpack this. Schedule C can absolutely feel like a beast when you first look at it. It's got lines and boxes, and it looks, well, complicated.
Can be intimidating, yeah.
But here's the thing. It's actually your most powerful roadmap. It's how you tell the IRS your business story, and crucially, how you keep more of your hard-earned money in your pocket.
Right. It's not just about compliance.
No, it's a strategic document for your financial health.
That's spot on. What's truly fascinating when you dig into these instructions is that they aren't just a set of rules you must follow.
Right.
They are, in fact, a comprehensive guide to financial optimization, understanding the nuances, the specific line items, the elections hiding in there.
The elections, yeah, those are key.
Absolutely. Understanding that stuff can transform what feels like a daunting chore into, well, a powerful strategy session.
I like the sound of that.
It's about leveraging every legal provision to your distinct advantage. And that's crucial for any business, really, regardless of its size.
Okay, so let's kick things off with the absolute basics. What exactly is Schedule C at its core? Who is it designed for? And why does it hold such a central place for so many of us operating independently?
Well, at its essence, Schedule C is the primary IRS form for sole proprietors.
Okay.
It's where they report all their income and expenses from a business or a profession. You can think of it like your business's individual report card to the IRS.
A report card, I like that analogy.
Yeah, it details its financial performance for the year. It's how you communicate to the government. Here's what my business activities were. Here's what it earned. And here's what it genuinely cost me to run it.
That makes perfect sense. But the instructions are quite clear about a crucial distinction. What truly defines a business for Schedule C purposes?
Ah, yes, that's fundamental.
I know it's not just any income-generating activity.
Yeah.
So where does the IRS draw that line, and how critical is that continuity and regularity distinction, especially, when it comes to maximizing deductions?
That distinction is absolutely fundamental, and it's a common point of confusion, honestly. To truly qualify as a business in the eyes of the IRS, your primary purpose for doing the activity must be to generate income or profit.
Profit motive.
Key. Precisely. And you must be involved with continuity and regularity. This isn't just semantics. It directly impacts the range and extent of deductions you can claim.
How so?
Well, a sporadic activity, something you do occasionally for fun, or maybe an activity that primarily serves as a not-for-profit hobby,
Right.
that does not qualify as a business for Schedule C. Income from those types of activities typically gets reported elsewhere.
Like where?
Usually on Schedule 1, Form 1040, Line 8J, other income.
Okay.
The crucial insight here is that a genuine business implies an ongoing, sustained effort. A dedication of time and resources with a clear intent to generate profit.
So it's about the intent and the effort level.
Exactly. That sustained dedication is what unlocks a much broader range of legitimate and impactful deductible expenses. And this is where the real tax savings begin to pile up. If you're consistently putting in time and effort, investing resources, actively seeking profit,
Then you're likely running a business.
you're likely running a business. If it's just something you do occasionally for enjoyment, maybe sell a few things here and there.
That's generally a hobby.
That's generally a hobby, and the tax implications are very different.
That's a great clarification.
Huh.
So if I, say, knit a few scarves in my spare time and sell them occasionally at a local craft fair,
Right.
that's probably a hobby, not a business needing a Schedule C. But what are the tax implications of that distinction? Why should someone care if their activity is classified one way or the other?
That's a perfect real-world example where the distinction truly matters. If your scarf knitting is classified as a hobby,
Okay.
while you do have to report any income you make from it,
Right. You always report income.
always report income. But your ability to deduct expenses is severely limited. You can only deduct hobby expenses up to the amount of income generated by that hobby.
Oh, okay. So no loss deduction,
Exactly. And these deductions are reported as itemized deductions on Schedule A?
which means they only help if you itemize.
Precisely. And even then, they are subject to certain limitations. Now, compare that to a full-fledged business.
Right.
You can deduct all ordinary and necessary expenses, even if those expenses result in a loss for the year.
Ah, the loss potential.
And here's the key tax saving. That business loss can potentially offset other income you have, maybe wages from a job or investment income,
Leading to lower overall tax.
potentially significant reductions in your overall taxable income. So that continuity and regularity aspect, along with the profit motive, is what transforms a casual pursuit into a potentially tax-advantaged business entity.
It's a foundational concept. Really changes your tax picture.
It absolutely can.
Okay, so Schedule C is clearly for traditional sole proprietors. We get that. But who else finds themselves needing to file this form? I know there are some surprising categories that might not immediately come to mind.
Absolutely. It's not just for the classic Main Street small business owner, the plumber or the graphic designer. For instance, statutory employees.
Statutory employees. Explain that.
If your Form W-2, your wage statement, has the statutory employee box checked in box 13,
Okay, I've seen that box.
then you actually report that income and any related expenses on Schedule C.
Interesting. So it looks like wages, but it's treated like business income.
For reporting purposes, yes. But here's the crucial tax-saving distinction. Social Security and Medicare tax should have already been withheld from those earnings.
Ah, so no self-employment tax on that income.
Correct. You do not owe self-employment tax on this specific income. This is a critical detail that impacts your Schedule SE calculation later.
Who falls into this category usually?
Common examples include full-time life insurance agents, certain agent or commission drivers, traveling salespersons, and certain homeworkers.
Okay.
And it's vital to note, if you have both general self-employment income and statutory employee income,
You can't mix them.
you must file two separate Schedule C. You cannot combine them. Each category requires its own distinct reporting.
That's a very specific but incredibly important detail for those it applies to.
Wow.
Now, what about married couples who run a business together? Is there a way to simplify things for them, maybe avoid the complexity of a full-blown partnership return?
Yes, definitely. This is where qualified joint ventures offer a significant simplification and potential tax saving for married couples.
Qualified joint venture. Okay.
If you and your spouse jointly own and operate an unincorporated business, you can elect to be treated as a qualified joint venture instead of a partnership.
Which would normally require filing Form 1065.
Yeah. Exactly. The partnership return, which is generally more complex. The requirements are fairly straightforward. Each spouse must materially participate in the business, a key concept we'll dig into later.
Material participation. Okay.
You must be the only owners, and you must file a joint tax return.
And the benefit.
The clear tax benefit is avoiding the complexity and extra filing requirements of Form 1065. It significantly simplifies your tax process.
But you still get Social Security credit.
Yes. Crucially, it still ensures each spouse gets credit for Social Security earnings based on their share of the profit. In most cases, it won't increase your total tax liability, it just streamlines how you report it.
Any catches?
One big one. This selection is not available for businesses operated through an LLC, a limited liability company.
Ah, okay. Good to know. And for the independent contractors, the freelancers, the ever-growing gig economy workers, Schedule C is basically their home base, right?
Precise. Schedule C is the go-to form for reporting amounts shown on Forms 1099 NEC, 1099 MISC, and 1099K.
The 1099s, everyone gets those, it seems.
They're very common now, especially with platform work. These forms are standard for independent contractors, freelancers, anyone engaged in on-demand work. If you receive one of these forms reporting income, Schedule C is typically where you'll account for that income and, importantly,
Deduct all your related business expenses.
exactly. That's where you offset the income with your costs.
What about single-member LLCs? Limited liability companies with just one owner? How do they fit into the Schedule C picture?
Good question. For federal income tax purposes, a single-member domestic LLC is generally not treated as a separate entity. It's what the IRS calls a disregarded entity.
Disregarded. Sounds harsh.
It just means for income tax, the IRS essentially looks through the LLC right to the owner. So the sole member simply files Schedule C or maybe Schedule E for rentals or F for farming as if they were a sole proprietorship. Unless they've made a specific election using Form 8832 for the LLC to be treated as a corporation. But that's less common for single-member LLCs.
Okay. Any other wrinkles for LLCs?
An important nuance. Even if it's a single-member LLC, if it has employees.
Employees change things.
Yes. It must use its own EIN employer identification number for employment tax returns, like payroll taxes. It can't use the owner's personal social security number or EIN for that.
Got it. EIN for employment taxes, even for a disregarded LLC. And before we move on, a quick but important note for married couples in certain states. Community property states.
You're right, that adds another layer. If you and your spouse wholly own an unincorporated business as community property under state law.
Which states are those, roughly?
Think Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin.
Okay.
In those states, you can choose to treat the community property business as a sole proprietorship. If only one spouse materially participates, all the income is treated as their self-employment earnings.
And if both participate?
If both participate, it's generally treated as a partnership unless they make that qualified joint venture election we just discussed if they're eligible.
So some flexibility there depending on participation in elections.
Exactly. And it can impact how self-employment tax is allocated, which affects each spouse's Social Security earnings record down the line.
Okay, great overview of who needs Schedule C.
Yeah.
Now, every tax year brings changes, updates, reminders. It's vital to stay current. What are some of the key updates for 2024 that folks filing Schedule C should have on their radar? Any new tax-saving mechanisms or important reminders?
There certainly are a few important updates and reminders for 2024 filings. First, a small procedural one for those filing Form 1040SS, which is used by residents of U.S. territories.
Okay.
If they claim a deduction for business use of home, that deduction will now be reported directly on Schedule C using Form 8829 to calculate it. Just centralizes things a bit.
Gotcha. What else? Anything with broader impact?
Yes. And this is a concrete tax-saving figure for many. The business standard mileage rate for 2024 is 67 cents per mile.
67 cents. That's up a bit.
Yeah.
Right.
It is. It adjusts annually for inflation and gas prices. This is a direct, quantifiable figure for a potential tax deduction for anyone using their vehicle for business.
Emphasizing again the need for meticulous mileage tracking.
Absolutely. Every single business mile counts towards that deduction.
That mileage rate is always a hot topic.
Yeah.
What about bonus depreciation? I know there's been a huge immediate deduction recently for buying assets.
Yes. Bonus depreciation under Section 168K has been very generous, but it's continuing its scheduled phase-out. For assets placed in service in 2024, the applicable limit is reduced from 80% last year down to 60%.
So still significant, but less than before.
Still a powerful tool for accelerating deductions on qualifying asset purchases. But yes, the percentage is lower. Businesses need to factor that into their planning for capital expenditures.
And business meals, still the same.
Generally, yes. The deduction for business meals usually remains at 50%. There are some important exceptions and nuances we'll definitely get into later when we talk about specific expenses.
Okay, now let's uncover a specific detail that you mentioned could be a huge tax saver, but easily missed. Those non-taxable Medicaid waiver payments. How exactly does that work? It sounded like a real aha moment.
It really is a crucial point, and honestly, overlooking it could lead to paying tax unnecessarily. So, if you receive certain Medicaid waiver payments, often reported on a 1099 MISC or 1099 NEC for providing home care services as a sole proprietor.
Okay.
These payments can be non-taxable under IRS Notice 2014-7, but the specific method for claiming this tax saving is precise, and you have to follow it exactly.
Have you do it?
You must report the full amount of these payments as income on Schedule C, Line 1, Gross Receipts.
Okay, so show it as income first.
Yes. Then, to ensure you don't pay tax on that excludable income, you immediately deduct the non-taxable and excludable amount way down in Part V, Other Expenses.
And you have to label it right.
Critically important. You write Notice 2014-7 right next to the amount you're deducting in Part V. This effectively zeroes out that income for tax purposes.
Wow. So you show the income, then take a specific deduction to back it out. That prevents overpaying tax on money that's legally excludable.
Exactly. It's a perfect example of a specific instruction that If you don't know about it, you might just pay tax on the whole amount. It really underscores the importance of digging into these details.
Absolutely. Any other general reminders or new resources from the IRS that our listeners should be aware of this tax season?
Yes. The IRS continues to promote its specific online resource, irs.gov gig, that's tailored for tax information related to on-demand work in the gig economy.
Very helpful for that growing sector.
Definitely. And a crucial reminder, especially for businesses that might experience fluctuations. If you report a loss on line 31 of Schedule C, you might be subject to an excess business loss limitation.
Excess business loss, what does that mean?
It means if your net business loss for the year is very large, above a certain threshold that's indexed for inflation, a portion of that loss might be disallowed in the current year.
Disallowed entirely.
No, that's the key. It's not about denying your loss permanently. It's about managing large losses. Any disallowed loss under this rule is treated as a net operating loss, NOL, and carried forward to a subsequent year.
So you still get the benefit, just later.
Precisely. It still offers a future tax benefit. It's just deferred until you have sufficient income in a future year to offset it. This mechanism helps manage large losses across tax years, ensuring fairness and preventing huge swings in taxable income due to a single large loss year.
Okay, that makes sense. So it really sounds like Schedule C is just the starting point, doesn't it? It feels like knowing these other forms is absolutely crucial for a complete, correct filing that captures all your potential tax savings.
It truly is. If we connect this to the bigger picture, these companion forms are like puzzle pieces. They all fit together to create your overall tax return.
And missing a piece.
Missing one could mean missing out on legitimate deductions or maybe even incurring penalties for incomplete or incorrect reporting. It's really an ecosystem of forms.
So beyond Schedule C itself, what are the most common companion forms people need to be aware of?
Well, top of the list is probably Schedule SC, Form 1040.
For self-employment tax.
Exactly. That's where you calculate your Social Security and Medicare contributions as a self-employed individual based on your Schedule C profit.
Okay, what else?
Form 45622. This is absolutely essential if you're claiming depreciation or amortization on any business assets you've purchased, equipment, vehicles, that sort of thing, or if you're taking that Section 179 deduction.
Right, the immediate expensing.
Then there's Form 8829. If you're deducting actual expenses for the business use of your home, not the simplified method, this is your form.
Actual expenses, Form 8829. Got it.
We just mentioned Form 461 for reporting an excess business loss, ensuring you carried over properly. Form 8990 might be needed to determine if your business interest deduction is limited. Although, good news, many small businesses are exempt from this limitation, which is a nice simplification.
That is good news.
Then there are Forms 8995 or 89995A. These are used to claim the deduction for qualified business income, or QBI. That can be a very significant tax benefit, up to 20% deduction for eligible pass-through businesses.
The QBI deduction, definitely worth looking into.
Absolutely. And finally, don't forget the Form 1099 series. If you made certain payments to others, like $600 or more to an independent contractor,
You might need to issue them a 1099 NCC.
exactly, or a 1099 MISC for things like rent. This is an important compliance requirement for many small businesses. Paying attention to these outflowing payments is just as important as tracking your income.
That's a comprehensive list. It really drives home the point that while Schedule C is central, it's part of a larger interconnected system of tax forms. Savvy business owners need to be aware of the whole picture.
That's the key takeaway, awareness of the whole picture.
Okay, now that we have a solid understanding of who files Schedule C and the landscape of related forms, let's shift our focus. Let's get into the nitty-gritty of the form itself, starting at the top. Accurately reporting all your business income.
Right, part one, IPCOM.
Knowing what money to declare is fundamental. And you mentioned there can be a few surprises here, things vital for ensuring you don't underreport, or maybe just as bad, overreport. What exactly goes on line 1, gross receipts?
Gross receipts on line 1 it's basically everything. It's where you enter the total income from all sources directly attributable to your trade or business
That's
activity.
the top line revenue.
Exactly. The sum of all money you receive from sales of goods or services before any expenses are taken out, it's the full picture of your business's earnings for the year.
So if I receive those forms, 1099 NEC or 1099K, Do those amounts automatically just get plugged into line 1?
They absolutely should be included, yes.
Yep.
And it's critical to verify them. You need to cross-reference any Forms 1099 you receive, the NEC for non-employee compensation, MISC for miscellaneous income, K for payment card, and third-party network transactions.
The key form is huge for online sellers and gig workers.
Very common now. You need to ensure those reported amounts are fully included in your line 1 total. And here's a critical compliance and, frankly, tax-saving point. If the total amount reported to you on your 1099 NECs, for instance, is more than what you're actually reporting as gross receipts on line 1, maybe because some payments were personal or belong on another form,
Right, that can happen.
you must attach a statement to your return explaining the difference.
And transparency.
Crucial. This transparency helps avoid red flags or unnecessary inquiries from the IRS asking why your reported income doesn't match the 1099s they received.
Good tip. Attach an explanation for discrepancies. Now, we briefly touched on statutory employees earlier. How is their income specifically reported on line 1? Is there a special way to mark it?
Yes, there is, and it's important. If you're a statutory employee, you enter your income directly from Box 1 of your Form W-2 onto Schedule C, Line 1.
Okay, W-2 Box 1 income goes on Schedule C, line 1.
Correct. And you must check the box right there on Line 1, indicating your status as a statutory employee.
Why is checking that box so important?
Because, as we mentioned, Social Security and Medicare tax should already have been withheld from these earnings. Checking that box flags it for the IRS and ensures that this income does not get subjected to self-employment tax when you fill out Schedule SE. It prevents double taxation.
Got it. Checking the box saves you from paying SE tax on that income. What about student athletes? NIL income, name, image, likeness. It's a relatively new world.
It is indeed a growing area, and yes, many young entrepreneurs might be navigating this for the first time. For student athletes, most NIL income, whether it's cash payments or non-cash benefits like free merchandise or gift cards,
Okay.
is generally considered self-employment income.
So Schedule C.
Typically, yes. It should be reported on Schedule C. The IRS generally views these student athletes benefiting from their NIL as independent contractors in these scenarios.
But you mentioned a distinction. Not all NIL income goes on Schedule C.
Right. Here's an important distinction that can affect which form you use. Royalties and other NIL income that is not considered self-employment income may be certain passive licensing payments where you're not actively involved.
Okay.
That type of income should generally be reported on Schedule E.
Schedule E for royalties and passive income.
Exactly. So knowing whether your NIL income is active business income, Schedule C, or more passive royalty income, Schedule E, is vital for accurate reporting. Getting it wrong could lead to issues.
Good to know. Definitely something for student athletes and their advisors to parse carefully.
Yeah.
Now, we just talked about that potential hidden tax-saving gem, those non-taxable Medicaid waiver payments. Can you quickly just reiterate the specific steps for claiming that tax savings? It's such a critical point.
Absolutely. It bears repeating because it's so easy to miss and can save eligible taxpayers real money. So again, if you provide home care services as a sole proprietor and receive certain Medicaid waiver payments, those payments may be non-taxable under IRS Notice 2014-7. The precise method for ensuring this tax saving is: Step 1, report the full amount of these payments as income on Schedule C, Line 1.
Included in gross receipts.
Yes. Step 2, to legally ensure you don't pay tax on that excludable income, you report the non-taxable and excludable amount as a deduction way down in Part V, Other Expenses.
The catch-all expense section.
Correct. And Step 3, critically, you write Notice 2014-7 right next to that deduction amount in Part V.
Label it clearly.
Yes. That notation tells the IRS exactly why you're taking that specific deduction. It effectively offsets the income reported on Line 1, ensuring it doesn't increase your taxable profit. It's a perfect example of following specific instructions to directly reduce your tax bill.
That's truly an aha moment. Show the income, deduct it with the right label. What about installment sales, where you sell something but get paid over multiple years?
Right, installment sales, where you sell property and receive payments over more than one tax year. Special rules apply there. Generally, you can't use the installment method if it's property you regularly sell on an installment plan or for real property you hold for resale.
Okay.
However, for certain sales, like specific residential lots and timeshares, you might be able to elect to pay interest on the tax due on that income after the year of sale. If you do use the installment method for an eligible sale,
What do you need to do?
you'll typically need to attach a detailed statement to your return. It should show the gross sales price, the cost of goods sold, the gross profit, and the amounts collected for the current year and the 3 preceding years.
Providing a clear trail for the IRS.
Exactly. It ensures the IRS has a clear picture of how that deferred income is being recognized for tax purposes over time.
Okay. So once we have our gross receipts nailed down on line 1, what about line 2, sales returns and allowances? This seems like a straightforward reduction from the top line.
It is, yes. Line 2 is indeed for reporting any refunds or reductions in the sales price you gave to customers. It directly reduces your gross sales.
What's the difference between a return and an allowance?
A sales return is pretty simple. It's a cash or credit refund you give when a customer returns a product. Maybe it was defective, damaged, or just unwanted.
Okay.
A sales allowance is a bit different. It's a reduction in the original selling price that you give to a customer, perhaps as an adjustment for a minor issue, instead of them returning the product for a full refund.
Gotcha. So a price adjustment rather than a full return.
Exactly. Both returns and allowances are reported here as a positive number, and they get subtracted from your gross receipts on line 1 to arrive at your true net sales figure. That net sales number is really the starting point for calculating your actual profit.
Okay, makes sense. Finally, in the income section, what about line 6, other business income? This sounds like a crucial catch-all, a place where some less obvious income streams might hide, and it's essential not to miss anything here, right?
This line is indeed a crucial catch-all for any business income that doesn't neatly fit on lines 1 through 5. And you're right, it's often where overlooked income and thus potential compliance risks can arise.
Like what kind of income ends up here?
Well, the crucial insight here is to rigorously review all sources of income, especially unusual or infrequent ones. For instance, a big one is recovered bad debts.
Recovered bad debts.
Yeah, if you previously deducted a bad debt because a customer didn't pay you, but then later they did pay you.
Ah, you collected it eventually.
Right. That recovered amount must be reported here on line 6 as income in the year you collect it.
Because you already got the tax benefit of the deduction earlier.
Precisely. Missing this isn't just an oversight, it's underreporting income. Other common items here include things like finance reserve income, money from selling scrap materials,
Okay.
interest income you earned on business notes, or maybe overdue accounts receivable, sometimes even state gasoline or fuel tax refunds you received during the year.
Fuel tax refunds. Interesting.
Yeah, if the state refunded tax you previously paid and deducted. It also includes amounts from certain specific tax credits, like the credit for biofuel claimed on Form 6478, or the credit for biodiesel on Form 8864. Sometimes the credit amount itself becomes taxable income.
Okay. Any others?
Less common, but possible. Prizes and awards related to your trade or business. Maybe amounts received as shown on Form 1099 PATR, which deals with patronage dividends. Any amount of credit you received for COBRA premium assistance.
What about depreciation recapture? That sounds complicated.
Ah, yes, recapture of excess depreciation. This is important for listed property.
Listed property, like what?
Things like cars, computers, if not used exclusively at a business location, certain entertainment equipment. If the business use percentage of any of these items dropped to 50% or less in 2024.
So you started using it more for personal reasons.
Exactly. You might have to recapture some of the depreciation you deducted in prior years. Basically, you add back a portion of your prior deductions as income here on line 6.
To reflect the reduced business use.
Correct. It's a safety net in the rules to ensure that the total depreciation claimed over the life of the asset aligns with its actual business use. It ensures prior deductions were appropriate based on ongoing usage.
Okay, that covers the income part. Now we get to the part everyone is truly interested in.
Yeah.
Expenses. Part 2. This is where the real magic of tax savings happens.
It certainly is where a lot of focus lies.
What's the golden rule for deducting a business expense? The fundamental principle. And how does understanding it help us maximize our savings?
The golden rule, the absolute bedrock for any deductible business expense, is that it must be both ordinary and necessary.
Ordinary, necessary. What do those terms mean in IRS language?
Ordinary means the expense is common and accepted in your specific trade, business, or profession. It doesn't have to be habitual, just, not unusual.
Okay. And necessary. Does it have to be absolutely essential?
No, that's a common misconception. Necessary simply means the expense is helpful and appropriate for your business. It does not have to be indispensable. This flexibility is actually key to finding all legitimate deductions. If it helps you run your business, it's likely necessary.
Helpful and appropriate. That's a broader standard than indispensable.
Much broader. However, there's a general rule of thumb we need to touch on: capitalization versus immediate deduction.
Right. Capitalizing costs.
Generally, if you produced real or tangible personal property, or if you acquired property for resale, basically, inventory, you usually must capitalize certain related expenses.
Meaning add them to the cost of the inventory or the asset.
Exactly. Instead of deducting them immediately, you add them to the inventory's cost or the asset's basis. This means the deduction is effectively spread out over time, often realized when the inventory is sold or the asset is depreciated. This naturally reduces the amounts you can immediately report on the expense lines in Part 2.
But wait, there's an important exception for smaller businesses, right? Something called the small business taxpayer exception that can simplify accounting and, crucially, accelerate deductions.
Yes. This is a huge win for smaller operations. It genuinely simplifies inventory management and can potentially accelerate deductions, which is a clear tax saving.
How small is small for this purpose?
You qualify as a small business taxpayer if your average annual gross receipts are $30 million or less for the 3 prior tax years. And you can't be a tax shelter.
$30 million or less average. That covers a lot of businesses.
It covers the vast majority of small businesses, yes. And the benefit is substantial. Small business taxpayers are not required to capitalize those certain costs to inventory.
So what can they do instead?
They have options. You can choose not to keep a formal inventory system for tax purposes. Instead, you can treat inventoriable items as what the IRS calls non-incidental materials and supplies.
Meaning you deduct them when?
You deduct their cost in the year they are first used or consumed in your business.
So much quicker than waiting for a sale.
Much quicker in many cases. Alternatively, you can simply choose to conform your tax inventory accounting to whatever method you use for your financial accounting, your books.
So more flexibility and faster deductions.
Exactly. This choice streamlines compliance significantly and can accelerate your deductions, providing immediate tax relief and improving cash flow. It's a really valuable exception.
That sounds like a wonderful simplification. And I heard there's also a specific exception tailored for creative property. Maybe for artists, authors?
That's correct. There's a special exemption from certain capitalization rules, specifically for freelance artists, authors, photographers, and similar creators.
How'd that work?
If their personal efforts created or are reasonably expected to create the property, like a manuscript or a painting, they may be able to deduct more of their expenses immediately rather than capitalizing them.
Helping individual creators deduct costs more directly.
Exactly. It recognizes the unique nature of their work. However, this specific exception doesn't apply to expenses related to things like printing, photographic plates, motion picture films, or videotapes. Those generally still follow standard capitalization rules.
Okay, good nuance there.
Yeah.
Now let's move to some of the potentially big-ticket deductions. And for many, none loom larger than car and truck expenses on line 9. How can people strategically claim these, and what's the best approach to maximize tax savings here?
This is a big one for sure. You have 2 main strategic choices for deducting your business vehicle expenses. You can use actual expenses or the standard mileage rate.
Okay, actual versus standard. Let's break down actual expenses first.
If you opt for actual expenses, you track and deduct the business portion of pretty much everything related to the car. Think gasoline, oil changes, repairs, tires, insurance, registration fees, license plates, pretty much. Depreciation for the vehicle itself would be listed separately down on line 13, and any rent or lease payments would go on line 20A. This method absolutely demands meticulous record-keeping of every single expense, plus your business mileage.
Okay, sounds like a lot of tracking. What's the alternative? The standard mileage rate.
Correct. The alternative, which is often simpler for many people, is the standard mileage rate. For 2024, as we mentioned, this is 67 cents per business mile.
Just multiply business miles by 67 cents.
Basically, yes. And on top of that calculated amount, you can also separately deduct any business-related parking fees and tolls.
Okay, parking and tolls are extra.
Right. But here's the crucial insight, the trade-off. If you choose the standard mileage rate, you cannot also deduct depreciation or rent lease payments or any of those actual operating expenses like gas, oil, or repairs.
Why not?
Because those costs are considered to be built into or covered by that 67 cents per mile rate. You can't double dip.
So that old advice about tracking every single business mile really pays off here. It offers a clear path to potentially a significant deduction, whichever method you use. How do you decide which method offers the most tax savings for your specific situation?
That choice can be highly strategic, and honestly, it often involves running the numbers both ways, at least initially.
Comparing the results.
Exactly. There are some rules about when you can use the standard rate. Generally, you can only use it if you own the vehicle and use the standard mileage rate for its very first year in service.
The first year matters.
It does. Or if you lease the vehicle, you have to use the standard mileage rate for the entire lease period if you choose it initially.
Okay. Any other restrictions?
Yes, if your business uses 5 or more vehicles simultaneously, like a small fleet, you must use the actual expense method. You can't use the standard rate in that case.
So for most sole proprietors with 1 or 2 cars, how do they choose?
To truly maximize your tax savings, the best approach is often to calculate your deduction using both methods for at least 1 year. Track your actual expenses and your mileage. Then see which calculation yields the larger deduction.
So do the math.
Do the math. It depends entirely on your actual costs versus the standard rate. If you have high repair bills or gas costs, actual might be better. If you drive a lot of miles in a fuel-efficient car, the standard rate might win out.
But regardless of the method,
Regardless of the method, record keeping is non-negotiable. You must provide detailed information on your vehicle's use. This means completing Schedule C, Part 4, or maybe Form 4562, Part V.
what info do they need?
Things like the date you placed the vehicle in service, total miles driven during the year, total business miles, commuting miles, and other personal miles. You need the records to back this up if the IRS asks. Meticulous records are your best friend here.
Absolutely. Sticking with assets, let's talk about line 13, depreciation and Section 179 expense deduction. This sounds like a powerful tax-saving tool, allowing businesses to recoup costs on major purchases like equipment or furniture. Can you break down what these are and why they're so impactful?
Definitely. Depreciation is, it's basically an annual deduction that allows you to recover the cost of business or investment property over its useful life.
Property that lasts more than a year.
Right. Things like equipment, machinery, furniture, even buildings, stuff that wears out or becomes obsolete over time. Depreciation generally starts when you first place the property in service for your business.
And it ends when?
It ends when you take the property out of service or when you've fully recovered its cost through depreciation deductions. One key point. Land is not depreciable. You can't depreciate land.
Okay, so that's regular depreciation spread out over years. What's Section 179?
Section 179. This is a really powerful tax-saving election. It allows you to choose to immediately expense, meaning deduct in the year you buy it, part or all of the costs of certain qualifying property.
Instead of depreciating it over many years.
Exactly. You deduct it upfront in the year you purchase it and place it in service for your business. There are limits, of course, but it can significantly reduce your current year's taxable income. It offers an immediate cash flow benefit by lowering your tax bill now.
That sounds like a huge incentive to invest in business assets.
It absolutely is. And complementing Section 179 is bonus depreciation.
We mentioned that earlier, the 60% for 2024.
Right. Bonus depreciation under Section 168 Quay allows you to deduct an additional percentage, 60% for 2024, of the cost of qualifying assets, often on top of any regular depreciation you might also take. It's another way to accelerate deductions into the current year.
So you might use Section 179, bonus depreciation, and regular depreciation all on the same asset.
The rules on how they interact can be complex, but yes, they often work together. You generally need to attach Form 4562 if you're claiming any depreciation on property placed in service during 2024, or if you're claiming depreciation on that listed property like cars, or if you're making a Section 179 expense election. Form 45622 is key here.
This is definitely where understanding the timing of your asset purchases can significantly impact your immediate taxable income. Section 179 and bonus depreciation really can be game changers for reducing your tax bill in the year of purchase.
Absolutely. For many businesses, especially those making significant investments in new equipment or technology, strategically utilizing Section 179 and bonus depreciation can provide a substantial upfront deduction. It directly impacts your cash flow and your tax burden for that year.
It sounds like a strong argument for making necessary equipment purchases strategically, maybe towards the end of the year if you're looking for last-minute deductions to lower that year's profit.
It can certainly be a factor in year-end tax planning, yes. If you know you need the equipment anyway, timing the purchase to maximize these deductions in a high-income year can be very beneficial. It's a key area for proactive tax optimization.
Okay, another potentially significant deduction, especially for the booming home-based business sector, is line 30, business use of your home. This feels like a deep dive in itself because there are two distinct options, each with its own advantages for tax saving. Can you walk us through those?
You're right. This is a substantial tax-saving opportunity for many, many home-based businesses, but you have to meet the strict eligibility rules first.
What are the main rules?
Generally, you can deduct a portion of your home-related expenses, things like mortgage interest, property taxes, rent if you rent, utilities, insurance, maybe even some repairs, but only if you use a portion of your home exclusively and regularly for business.
Exclusively and regularly. Key term.
Very key. Exclusively means that space is used only for your business, not also as, say, a family room.
Yep.
Regularly means you use it on an ongoing basis. And generally, your home must be your principal place of business.
Your main office.
Right. Or it needs to be a place where you regularly meet with patients, clients, or customers in the normal course of your business. Or it could be a separate structure on your property, like a detached studio, used exclusively and regularly for business.
What about storing inventory?
There's a slight exception there. For storage of inventory or product samples, the exclusive use test isn't required if your home is the sole fixed location of your trade or business. The space still needs to be used regularly for storage, though.
Okay, so assuming you meet those tests, what are the two methods for actually calculating the deduction, and how do they differ in terms of, well, simplicity versus potential savings?
You have two primary methods to choose from. The first is let's call it the regular or actual expense method, which involves using Form 8829.
Form 8829, okay.
This method requires detailed record keeping of all your actual home expenses, mortgage interest, taxes, insurance, utilities, repairs, etc. Then you have to calculate the percentage of your home that's used for business, typically based on square footage.
So measure the office, divide by total square footage.
That's the most common way, yes. You apply that percentage to your indirect home expenses. Direct expenses, like painting just the office, are fully deductible. A key benefit of this method is that it allows you to claim depreciation on the business portion of your home itself.
Depreciating your house.
Well, the structure, not the land. Over many years, this depreciation deduction can be quite sizable and potentially lead to greater overall tax savings, especially for homeowners with significant home value or high home expenses.
Okay, that's the detailed method. What's the alternative?
The second, and often much more user-friendly option, is the simplified method.
Simplified sounds good.
It is. It's a powerful tax-saving alternative primarily because of its simplicity. With this method, you just multiply the area in square feet that you use regularly and exclusively for business.
Business square footage.
Right. You multiply that by a prescribed rate, which is currently $5 per square foot.
$5 per square foot. Is there a limit?
Yes, there's a cap. The maximum area you can use for this calculation is 300 square feet.
So 300 square feet times $5 means?
A maximum deduction of $1,500 per year using the simplified method.
Okay, $1,500 max. What's the main benefit here?
The huge benefit is that it eliminates the need to calculate and substantiate all those actual expenses for your home. No need to track utility bills, insurance costs, etc. specifically for the deduction. It significantly simplifies record keeping.
And you just claim it directly on Schedule C. No Form 8829.
Correct. If you use the simplified method, you report the deduction directly on Schedule C, line 30, and you do not file Form 8829. It's also an annual election.
Meaning you can switch back and forth.
Yes, you can choose each year whether to use the simplified method or the actual expense method. You can switch between them year to year without needing special IRS permission.
Okay, so the simplified method is definitely easier, less paperwork, quick calculation, up to $1,500. But it sounds like there's a trade-off, right? You might be leaving money on the table compared to the actual expense method.
That is the potential trade-off, yes. You're trading potentially higher deductions for simplicity.
So how would someone decide which method is truly best for them to maximize their tax savings?
That's the million-dollar question, or maybe the $1,500 question. It really comes down to balancing simplicity with the potential deduction size. For many folks, especially renters or those with relatively minor home office expenses, or just those who highly value ease of compliance,
This simplified method might be perfect.
it offers excellent tax savings with minimal hassle. It's straightforward, no fuss. However,
If your actual expenses are high.
right, if your actual allocable home expenses, think mortgage interest, property taxes, home insurance, utilities, repairs, and especially home depreciation, add up to more than $1,500 or $5 per square foot if your space is under 300 SECU feet.
then the actual method is better.
Then the detailed Form 8829, the actual expense method, is likely the more financially beneficial path. It requires more work, more record keeping, but the potential deduction could be significantly larger.
So it's a classic case of knowing your numbers.
Absolutely. The best advice is often to track your actual expenses for at least 1 year, calculate the deduction both ways, and then compare. See which method yields the greater tax benefit for your specific situation.
Are there other limitations to the simplified method besides the $1,500 cap?
Yes, a few important ones. First, as we touched upon, if you use the simplified method, you cannot deduct any depreciation for the portion of your home used for business. You give up that specific deduction.
But you can still depreciate, say, your office desk or computer.
Oh, yes, absolutely. You can still depreciate other business assets like furniture or equipment that are used in your home office. The limitation is just on depreciating the home structure itself.
Okay. What else?
Another key limitation of the simplified method is the gross income limitation. Your home office deduction, using either method actually, cannot exceed the gross income derived from the qualified business use of your home minus your other business deductions not related to the home. Basically, the deduction can't create or increase a net loss from the business use of your home.
So you need enough business income to cover it. What happens if the limit reduces your deduction under the simplified method?
This is a crucial difference. If the income limitation reduces your simplified method deduction, you cannot carry over the unused difference to another tax year. It's just lost for that year.
But with the actual method?
With the actual method, Form 8829, if your deduction is limited by income, the unallowed expenses can be carried over to future years and potentially deducted then. That's a significant advantage of the actual method if you have fluctuating
The
income.
carryover potential is a big deal. Anything else for the simplified method? Part year use.
Yes, if your business use was only for part of the year, maybe you started mid-year, stopped, moved, or had a seasonal business, you need to calculate an average monthly allowable square footage.
How did that work?
You basically figure out the square footage used for each month, or part of a month, you qualified, add those up, and divide by 12. For example, if you used 300 square foot for 6 months, your average for the year would be 306.12 equals $156. You'd then multiply that average square footage by $5.
So it prorates the deduction fairly.
Exactly. Ensures fairness for partial year use. And one last point. If you use the actual method, Form 8829, in a prior year and had actual expenses carrying over due to income limitations, you cannot claim those carryover expenses in a year you switch to the simplified method. They're held in suspension until you file Form 8829 again in a future year.
Wow. Okay. That's incredibly helpful. It shows how even a deduction that sounds simple has layers of nuance that can significantly affect your overall tax strategy and savings. Now, let's quickly run through some other crucial expense categories. These might seem smaller in isolation, but they absolutely add up to significant savings if tracked diligently. Think of this as your checklist for potential deductions.
Absolutely. Every legitimate deduction counts. Let's hit some key ones in Part 2. Line 10. Commissions and fees. Pretty straightforward, total commissions and fees paid for the tax year. Just remember, fees paid to help facilitate the sale of property generally have to be capitalized, added to the property's basis.
Unless you're a dealer.
Right, unless you are a dealer in that type of property. And don't forget the 1099 NEC rule. If you paid $600 or more in commissions to an individual who isn't your employee, you likely need to issue them a Form 1099 NEC.
Got it. What about line 11, contract labor?
This is specifically for payments to independent contractors, people you do not treat as employees, for services performed for your business.
So your freelancers, consultants.
Exactly. Do not include employee salaries here. Those go on line 26. And again, that $600 threshold for issuing a 1099 NE applies here too. Very important compliance point.
Okay. Line 12, depletion. Sounds specific.
It is. Depletion is similar to depreciation, but it's for natural resources. Think oil, gas, minerals, timber. It's how businesses recover their investment in these resources as they're used up. It's often an item of tax preference for the alternative minimum tax, or AMT, less common for most Schedule C filers, but vital for those in resource industries.
Right. Line 14, employee benefit programs. What goes here?
This is where you deduct contributions you made for your employees' benefit plans, things like accident and health plans, group term life insurance premiums up to certain limits, dependent care assistance programs.
What about benefits for the owner, the self-employed person?
Crucial distinction here for tax savings. Do not include contributions made on your own behalf as a self-employed person to an accident and health plan on this line.
Where do those go?
Those payments, your health insurance premiums, may be deductible on Schedule 1, Form 1040, line 17, as the self-employed health insurance deduction.
And that's valuable because...
It's an above-the-line deduction. It reduces your adjusted gross income directly, which is often more beneficial than an itemized deduction. Also, reduce your line 14 deduction by any credit you claimed for small employer health insurance premiums.
Good tip. Line 15. Insurance. Business insurance.
Yes, premiums paid for business insurance liability, property, malpractice, workers' comp, etc. But do not deduct amounts set aside for self-insurance reserves or premiums for policies that pay for your lost earnings due to sickness or disability. Those aren't considered business operating insurance.
Okay. Line 16A and 16B. Interest. Looks like 2 lines here.
Right. Line 16A is specifically for mortgage interest paid on real property used in your business. This is often reported to you on Form 1098 from the lender.
And 16B?
Line 16B is for other interest. This is where you deduct other deductible business interest, like interest on business loans for equipment, lines of credit, maybe even business credit cards.
Is there a limit on how much business interest you can deduct?
For larger businesses, yes, the business interest deduction may be limited, potentially requiring Form 8990. However, another significant tax saving for smaller folks, small business taxpayers, remember, average annual gross receipts of $30 million or less are generally exempt from this limitation.
So most Schedule C filers can deduct their full business interest.
Generally, yes. That exemption is a major simplification and ensures full deductibility for most small businesses.
Excellent. Line 17. Legal and professional services, accountant and lawyer fees.
Exactly. Fees charged by accountants and attorneys that are directly related to operating your business. This specifically includes fees for tax advice related to your business and for the preparation of the business-related parts of your tax return, like Schedule C itself.
Good to know tax prep fees for the business part are deductible here. Line 18. Office expense. What fits here?
This is for your general office supplies, paper, pens, staples, printer ink, and postage costs. Smaller, consumable items.
Okay. Line 19. Pension and profit-sharing plans. Is this for the owner's retirement?
No, another crucial distinction here. Line 19 is for deducting contributions made for the benefit of your employees' retirement plans.
So if I have employees and offer a 401k or a simple IRA,
the employer contributions you make for them go here, but contributions made as an employer on your own behalf as a self-employed person.
to my own SEP IRA or solo 401k.
Exactly. Those go on Schedule 1, Form 1040, line 16. Again, that's a powerful above-the-line deduction that can significantly reduce your taxable income if you contribute to a self-employed retirement plan. Don't miss that one.
Definitely not. Okay, lines 20A and 20B, rent or lease payments. 2 lines again.
Right. Line 20A is for renting or leasing vehicles, machinery, and equipment. So the business portion of your car lease payment, if you lease instead of own and use actual expenses, would go here. Be aware of potential inclusion amounts for expensive leased vehicles, IRS rules to limit deductions on luxury car leases.
And line 20B.
That's for renting or leasing other property. Primarily, this is where you deduct rent paid for office space, a storefront, a workshop, or other property used in your business.
Makes sense. Line 21, repairs and maintenance. What's deductible here versus needing capitalization?
This is for the cost of incidental repairs and maintenance that do not materially add to the property's value or appreciably prolong its useful life. Think routine upkeep, fixing a broken window, patching a wall.
So maintaining, not improving.
Exactly. Costs that restore property to its normal operating condition or replace major components like a whole new roof or a major engine overhaul generally must be capitalized and depreciated, not expensed here.
Okay. Line 22, supplies. How is this different from office expense on line 18?
Supplies on line 22 are generally materials and supplies that are actually consumed and used in operating your business during the tax year. This could be raw materials for a manufacturer, cleaning supplies for a cleaning service, packaging materials. It can also include the cost of books, professional instruments, or equipment if they normally have a useful life of 1 year or less.
So things used up in the business operation itself.
Right. Whereas line 18 is more focused on general office administration items. If something lasts longer than a year, you generally need to depreciate it, line 13, rather than expensing it here.
Got it. Line 23, taxes and licenses. What kind of taxes are deductible business expenses?
A variety, actually.
Yeah.
Deductible taxes include state and local sales taxes imposed on you as the seller of goods or services, if you have to remit them. Also, real estate and personal property taxes paid on business assets, like property tax on your owned office building or business vehicles.
What else?
Annual business licenses and regulatory fees paid to state or local governments. The employer's share of Social Security and Medicare taxes paid for your employees. Federal unemployment tax, FUTA. Federal highway use tax. Contributions to state unemployment insurance or disability funds if they're considered taxes under state law.
What's not deductible here?
Critically, you cannot deduct federal income taxes here, including your own self-employment tax. Estate and gift taxes are out. Taxes assessed for improvements, like special assessments for sidewalks or sewers that increase property value, usually get added to the property's basis instead. And taxes on your personal home or personal property don't belong on Schedule C.
But wait, you mentioned a tax saving related to self-employment tax.
Yes. While you can't deduct the SE tax itself here, remember that crucial deduction. You can deduct 1/2 of your self-employment tax calculated on Schedule SE. That deduction is taken on Schedule 1, Form 1040, line 15. It's a direct reduction of your adjusted gross income, a very valuable offset.
Okay, deduction for 1/2 of SE tax on Schedule 1. Got it. Now, the meal deduction rules seem to have more twists than a pretzel. Lines 24A for travel and 24B for meals. Can you untangle these for us? Knowing the 50% ask 80% rule and the option for standard allowances seems key for saving here.
You're right. It's an area with specific rules that can trip people up, but understanding them definitely unlocks legitimate deductions. Let's start with travel, line 24A.
Okay.
This line is for ordinary and necessary expenses incurred while traveling away from home overnight for your business. This includes things like lodging, airfare, rental cars, taxis, train fare.
Overnight is key.
Overnight and away from your tax home, which is generally your regular place of business. Importantly, this line does not include entertainment expenses. Those are generally non-deductible now. There are also limits on deductions for conventions held outside the North American area.
Any simplification for small travel costs?
Yes, a small but useful tax-saving tip. Instead of tracking every single incidental expense while traveling, like tips for luggage handlers, etc., but not meals, you can use an optional standard allowance of $5 per day for these incidentals if you did not incur or claim meal expenses for that day. It simplifies record keeping for those small, hard-to-track costs.
Okay, $5 a day for incidentals if no meals claimed. Now, what about business meals, line 24B? This is where the percentages come in.
Right. For business meals, the general rule is that they are only 50% deductible. This limit applies whether you're using the actual cost of the meal or a standard meal allowance.
50% deductible. What are the conditions for deducting even that 50%?
Several conditions must be met. The meal expense must be ordinary and necessary. It can't be lavish or extravagant under the circumstances. You or one of your employees must be present at the meal, and the meal must be provided to a current or potential business customer, client, consultant, or similar business contact.
What about meals during entertainment?
Good point. If food and beverages are provided during or at an entertainment activity, their cost must be purchased separately from the entertainment, or at least stated separately on the bill or invoice. Because the entertainment cost itself is generally not deductible, but the separately stated food and beverage cost might be, subject to the 50% limit.
Okay, 50% is the general rule. Are there exceptions? You mentioned an 80% rule.
Yes, there's a specific tax-saving exception for certain workers. For individuals subject to the Department of Transportation, DOT, hours of service limits, think pilots, aircrew, interstate truckers, certain mariners, the deduction percentage for business meals consumed while away from home on duty is increased to 80%.
80% for those specific transportation workers. That's a significant difference.
It is, recognizing the nature of their work. Now, instead of tracking every single meal receipt while traveling,
There's a standard allowance.
yes, you can use a standard meal allowance, also known as per diem rates for meals and incidental expenses, M&IE. These rates vary by location and are set by the General Services Administration, GSA. You can find them easily on gsa.gov travel.
So you use the per diem rate instead of actual cost.
Right. It can significantly simplify record keeping, especially for frequent travelers. You still need to keep records of the time, place, and business purpose of your travel, but you don't need every single meal receipt if you use the standard allowance. The 50% or 80% for DOT workers limit still applies to the standard allowance amount.
Any other groups with special meal rules?
Yes, family daycare providers. They can use standard meal and snack rates for eligible foods served to children in their care rather than tracking actual food costs. That's another helpful simplification.
Okay, the meal rules are complex, but knowing the 50-80% distinction and the standard allowance option offers flexibility. What about line 25, utilities?
Utilities on line 25 are fairly straightforward. Deduct the cost of utilities like electricity, gas, water, internet service, but only for your trade or business use.
What about a home phone line?
For a phone line in your home, the rules are specific. You generally cannot deduct the basic local service charge, including taxes, for the first phone line into your residence, even if you have an office in the home.
So the main home line base cost is out.
Generally, yes. But you can deduct any additional costs incurred specifically for business, like the cost of a second phone line used exclusively for business, or the business percentage of your long-distance calls on any line. Cell phones used for business follow similar allocation rules based on business versus personal use.
Makes sense. Line 26. Wages. This is for employees, right?
Correct. Line 26 is where you deduct the total gross salaries and wages paid to your employees during the tax year.
Gross wages, before taxes are taken out.
Yes, gross wages. And again, crucially, do not include any amounts paid to yourself as the owner sole proprietor. Your pay comes from the net profit of the business.
Okay. Any adjustments to the wage deduction?
Yes, you need to reduce your deductible wage amount by certain employment credits you might claim related to those wages. For example, the work opportunity credit or the employer credit for paid family and medical leave. You can't get both a full wage deduction and a full credit for the same wage dollars. And of course, you're generally required to issue Form W-2 to each employee.
Right. And a quick mention of line 27B, energy efficient commercial buildings deduction.
Yes, this is a potentially significant deduction under Section 179D if you've made qualified energy-efficient improvements to a commercial building you own or lease. It requires specific certification and calculations, often detailed on Form 7205, worth looking into if you've done energy upgrades.
Okay. That covers most of the numbered expense lines. But now we get to Part V. Other expenses. Line 48. This sounds like the ultimate catch-all, maybe where some hidden gems of deductions reside. What sorts of ordinary and necessary business expenses end up here because they weren't deducted elsewhere?
This is indeed the true catch-all for ordinary and necessary business expenses that don't have their own dedicated line in Part 2. It's absolutely vital to meticulously go through this section and think about all your business costs, because it often contains deductions that can be easily overlooked but offer significant tax savings. Don't just skip Part 5.
So what are some examples of these other expenses?
Well, there are quite a few possibilities. Things like amortization. This is similar to depreciation, but it's for intangible assets or certain capitalized costs. You deduct the cost over a set period. Examples include costs for pollution control facilities, research and experimentation costs, though rules changed recently here, geological surveys, maybe trademarks or goodwill if acquired as part of a business purchase. Amortization is usually calculated on Form 4562.
Okay, amortization goes here.
At-risk loss deduction carryovers. Remember those at-risk rules limiting losses? Any business loss that wasn't allowed in a prior year because of the at-risk rules can generally be treated as a deduction here in the current year, assuming you now have sufficient at-risk basis.
So you finally get to claim that suspended loss.
Right. Bad debts. If you use an accrual method of accounting and have debts from sales or services that were previously included in your income and they become genuinely worthless,
You could deduct them here.
yes, you can claim a bad debt deduction here. But remember, if you later recover a bad debt you deducted, you have to include the recovery in income back on line 6.
Now, one you mentioned earlier that sounds fantastic for new businesses. Business startup costs. How does that work as a tax saver?
This is a key tax saver for new ventures, a real boost for entrepreneurs. If your trade or business began operations in 2024, you can elect to deduct up to $5,000 of certain business startup costs incurred before opening day.
$5,000 up front, that's great.
It is. There's a catch. This $5,000 immediate deduction limit is reduced dollar for dollar if your total startup costs exceed $50,000.
Okay, so it phases out for really high startup costs. What happens to costs above the $5,000 limit or if you're over the $50,000 total?
Any remaining startup costs, those not deducted immediately, can then be amortized, deducted ratably over a 180-month period, beginning with the month the business actually starts operating.
So you still get to deduct them just over 15 years. But getting that $5,000 up front is huge.
It significantly accelerates the deductions, providing a welcome financial boost in those crucial early stages when cash flow might be tight. It's much better than having to amortize everything over 15 years.
Definitely. What else fits in other expenses?
The deduction for removing barriers to individuals with disabilities and the elderly. Businesses may be able to deduct up to $15,000 of costs paid or incurred in 2024 to make their facilities or transportation vehicles more accessible. Note, you generally can't take both a credit, like the disabled access credit, and this deduction for the exact same expenditures.
Okay, accessibility improvements.
And as we've discussed multiple times because it's so important, this is where you list the non-taxable Medicaid waiver payments deduction.
Yeah.
You put the non-taxable amount here, right? Notice 2014-7 next to it to offset the income you included back on line 1.
Got it. Now, another really important one you flagged, especially for smaller businesses managing asset purchases, the de minimis safe harbor for tangible property. This sounded like a major tax-saving election that simplifies things quite a bit.
It really is. This is a prime example of a seemingly small rule that can lead to big savings and much, much simpler record keeping for many small businesses.
How does it work? What's a safe harbor?
Okay, so instead of having to capitalize and then depreciate the cost of certain tangible property items, think smaller equipment, furniture, tools, maybe even computers or tablets, you can elect to immediately deduct the full cost if it falls below a certain threshold. That's the de minimis or minimal amount.
Immediately deduct instead of depreciating over years. What are the thresholds?
There are 2 thresholds, depending on whether you have what the IRS calls an applicable financial statement or AFS.
An AFS, what's that?
An AFS is generally a certified audited financial statement, or maybe one that's filed with the SEC, or even just one required by a federal or state agency or for a loan. If you have an AFS, you can use this safe harbor to immediately deduct items costing up to $5,000 per item or per invoice.
$5,000 per item. Wow. And if you don't have an AFS, which is probably more common for very small businesses.
If you don't have an applicable financial statement, the de minimis safe harbor limit is $2,500 per item or per invoice.
Still, $2,500 per item immediately expensed is pretty significant.
It's very significant. The benefit is twofold. First, it dramatically simplifies your accounting and record-keeping. No need to track depreciation schedules for all these smaller assets. Second, and more importantly for tax savings, it accelerates your deductions into the current year, putting more cash back in your pocket faster.
So instead of waiting 5 or 7 years to deduct that $2,000 laptop, you deduct it all now.
Exactly. It's a powerful tool for managing your immediate tax liability on everyday business purchases. It really cuts down on administrative burden and boosts current year deductions. You make this election annually by attaching a statement to your return.
Fantastic tip. What else might land in Part V?
Just a couple more specialized ones. There are specific rules allowing elections to deduct costs for certain qualified film and television and live theatrical productions under Section 181.
Okay, for production companies.
Right. And for businesses involved in timber, there are rules related to forestation and reforestation costs. For each qualified timber property, you might be able to elect to immediately expense up to $10,000, $5,000, if married filing separately, of qualifying reforestation costs paid in 2024. Any remaining costs can be amortized over 84 months.
Specialized, but very valuable for those industries.
Exactly. Part V is really about capturing everything else that's ordinary and necessary, but didn't fit neatly elsewhere.
Okay, we've covered income in Part 1, the myriad expenses in Part 2 and Part V. Now it's time for the moment of truth. Calculating your net profit or loss on line 31 in Part 2. This is where all those prior calculations converge.
Right, the bottom line of Schedule C itself.
But you mentioned it's not always as simple as just subtracting total expenses from total income, especially if you have a loss. There are crucial limitations that might apply before you finalize that line 31 number.
Correct. Line 31, your net profit or loss, is essentially your gross income from Part I minus your total expenses from Part 2, including that home office deduction from line 30, if applicable. It is your business's bottom line for the schedule. However, and this is a crucial insight for anyone showing a loss, if your expenses are more than your gross income, you don't just enter that negative number on line 31 and move on without checking some specific limitation rules first.
Why not?
Because certain tax rules might limit the amount of loss you can actually claim on your tax return in the current year. Applying these limitations is vital for accurate tax reporting. It often involves carrying disallowed losses forward, ensuring they still provide a future tax benefit, just not always right now. Okay, so what are these key limitation rules we need to check if we have a loss? I know you mentioned the at-risk rules on line 32 earlier. They're designed to align deductions with actual financial exposure, right?
Exactly. The at-risk rules, which are calculated using Form 6198 if they apply, generally limit the amount of loss you can claim from an activity to the amount you personally have at risk in that activity.
What does at-risk mean in this context?
It's basically the amount of money you've invested in the business that you could actually stand to lose. This includes cash you contributed, the adjusted basis of property you've contributed, and amounts you've borrowed for the business for which you were personally liable for repayment.
What's not considered at risk?
Generally, you're not considered at risk for amounts like non-recourse loans, where the lender can only take the property securing the loan if you default, but can't come after your personal assets, or amounts for which you're protected against loss by a guarantee, stop-loss agreement, or similar arrangement.
So the at-risk rules are essentially saying you can only deduct losses up to the amount of money you truly have on the line in your business, preventing excessive deductions from, say, passive or protected investments.
That's a perfect way to put it. The core insight is you can only deduct losses up to the amount of money you genuinely stand to lose. It ensures deductions reflect true economic risk.
What happens to losses disallowed by the at-risk rules? Are they gone forever?
No, thankfully not. Any disallowed loss due to these rules is generally treated as a deduction allocable to that same activity in the next tax year. So it's suspended and carried forward. You might be able to deduct it in a future year if your at-risk amount increases or if the activity generates income.
Okay, so loss is deferred, not lost. That's the at-risk rule. What other limitations might apply to a Schedule C loss?
Next up are the passive activity loss rules. These might come into play depending on your level of involvement in the business.
Related to that material participation question on line G we discussed.
Precisely. If you checked no on line G, meaning you did not materially participate in the business activity according to his IRS tests.
Or if it's a rental activity.
Or if it's a rental activity, which is generally considered passive by definition, though there are exceptions for real estate professionals, then your loss may be limited by the passive activity loss rules. You'd likely need to file Form 8582 to figure this out.
And how do passive loss rules limit the deduction?
The crucial insight here is that passive losses can generally only be used to offset passive income. You typically can't use passive losses to offset non-passive income like wages, interest, dividends, or income from a business you do materially participate in.
So if I have a passive loss from one venture but no passive income from anywhere else?
That passive loss is typically suspended and carried forward to future years. It can then be used to offset passive income in those future years, or sometimes it becomes fully deductible when you dispose of your entire interest in the passive activity in a taxable transaction.
Okay, loss suspended again, potentially usable later against the right kind of income. Any other major loss limitations?
One more layer. The excess business loss limitation. We touched on this briefly. Even after applying the at-risk and passive activity rules, if your overall net business loss from all your trades or businesses combined is very large.
Above a certain threshold.
Yes, above an annual threshold, $289,000 for single filers, $578,000 for joint filers in 2023, indexed annually. A portion of that total loss might be disallowed in the current year under this rule. You'd use Form 461 to calculate this.
And what happens to the excess loss?
Similar to the other rules, the disallowed excess business loss is not lost forever. It's carried forward to the following year as a net operating loss, NOL.
So it becomes part of your NOL carry forward.
Exactly. The key takeaway from all these limitations at risk, passive activity, excess business loss, is that they aren't there to punish you for having a loss. They're designed by Congress to align tax deductions more closely with economic reality, your level of financial risk, and your degree of involvement. They aim to ensure a fair and equitable tax system.
And understanding them is crucial for planning.
Absolutely. Understanding these rules allows for better financial planning and ensures you properly manage and carry forward any disallowed losses, because those suspended losses can still be valuable tax assets in future years. Don't just ignore them if they're disallowed this year.
Great point. So once all those potential limitations are applied and we have our final allowable net profit or loss figure on Schedule C, line 31, where does that number ultimately go on the main personal tax return, the Form 1040?
For individuals, that final net profit or loss figure from Schedule C, line 31, flows directly onto Schedule 1, Form 1040, specifically on line 3.
Schedule 1, line 3.
Right. Schedule 1 is used to report various types of additional income or adjustments to income that aren't listed directly on the main Form 1040 page. The total from Schedule 1 then flows onto your Form 1040.
Okay. Now, if line 31 shows a profit, we're not quite done yet, are we? There's that self-employment tax.
Correct. If you have a net profit on line 31, generally $400 or more, you usually must also include this amount on Schedule SE, Form 1040, typically on line 2.
Schedule SE, calculates the self-employment tax.
Exactly. That's where you calculate your self-employment tax liability, which covers your contributions to Social Security and Medicare as a self-employed individual. It's the equivalent of the FICA taxes withheld from an employee's paycheck.
So even if you made money, you're not done yet. There's another tax to consider, but thankfully you mentioned there's a specific deduction to help offset it.
Yes, absolutely. While you have to pay self-employment tax on your net profit, there's a significant tax saving built in. You get to deduct 1/2 of your calculated self-employment tax.
Where does that deduction go?
That deduction is taken back on Schedule 1, Form 1040, line 15.
Another Schedule 1 deduction.
Yes. And importantly, it's an above-the-line deduction. That means it reduces your adjusted gross income, AGI. Reducing your AGI is generally very beneficial, as it can lower your overall taxable income and potentially help you qualify for other tax credits or deductions that have AGI phase-outs. Don't miss that deduction for 1/2 of your SE tax.
Definitely not. Anything else related to the Schedule C profit? Credits, maybe?
Yes. If you have a net profit on line 31, that amount generally counts as earned income. And having earned income is a key requirement for qualifying for the Earned Income Credit, EIC.
The EIC can be quite valuable,
That
right?
can be a very valuable refundable tax credit for low to moderate income working individuals and families. So your Schedule C profit not only potentially subjects you to SE tax, but also might help you qualify for the EIC, which could put significant money back in your pocket.
Good point. Now, for businesses that involve producing or selling merchandise, we skipped over Part 3, cost of goods sold earlier. This can be a significant calculation affecting the gross profit. What's important to know here, especially regarding that small business taxpayer exception.
Right. Cost of goods sold, COGS, in Part 3 is crucial for businesses that sell physical products. If your business involves producing, purchasing, or selling merchandise, you generally must take inventories into account at the beginning and end of your tax year to accurately determine your cost of goods sold.
Which means tracking inventory levels and values.
Traditionally, yes. Calculating COGS involves starting with your beginning inventory, adding the cost of purchases and other costs to prepare goods for sale, like labor and materials, and then subtracting your ending inventory. The result is the cost of the goods you actually sold during the year.
But the small business taxpayer exception applies here too.
Yes, and it's a huge simplification. Again, if you qualify as a small business tax, get average annual gross receipts of $30 million or less, you can choose not to keep a formal inventory system for tax purposes.
So no need to track beginning and ending inventory values for tax.
Correct. Instead, you can choose to treat your inventoriable items as those non-incidental materials and supplies.
Meaning you deduct their cost when?
You deduct them in the year they are used or consumed in your business, or alternatively, you can elect to simply follow the inventory method you use for your financial accounting purposes, your books.
How does this simplify things and save taxes?
It significantly simplifies compliance by removing the often burdensome task of detailed inventory tracking and valuation required under traditional tax inventory rules. And it can potentially accelerate deductions by allowing you to expense inventory costs sooner when used or consumed, rather than waiting until the goods are actually sold and matching the cost then. It's a prime example of the tax code directly benefiting small businesses by reducing complexity and potentially enhancing cash flow through faster deductions.
That's a fantastic option for eligible businesses selling goods. Definitely worth exploring if you qualify.
Absolutely. It removes a major accounting headache for many smaller retailers and manufacturers.
Okay, we've gone through the numbers, income, expenses, profit loss, COGS. But beyond the pure numbers, Schedule C also requires you to address some fundamental operational details about your business that can have tax implications. Let's start with Line F accounting methods. What are the common methods and what are the strategic implications?
Right. Line F asks about your accounting method. You generally need to use a method that clearly reflects your income and expenses. The two most common methods for Schedule C filers are the cash method and the accrual method.
Cash versus accrual. What's the difference in simple terms?
Under the cash method, you generally report income in the year you actually or constructively receive it. Constructively means it's made available to you even if you haven't deposited the check yet. And you generally deduct expenses in the year you actually pay them.
So it follows the cash flow pretty closely.
Exactly. It's often simpler to track for smaller businesses and gives a clearer real-time picture of cash on hand. Now, under the accrual method, you generally report income in the year you earn it, regardless of when you receive the payment.
Earned means you did the work or delivered the goods.
Right. When the right to receive the income is fixed. And similarly, You deduct expenses in the year you incur them, regardless of when you actually pay the bill.
So it matches income and expenses to the period they relate to, regardless of cash.
Correct. The accrual method generally provides a more accurate picture of a business's financial performance and profitability over a given period, matching revenues with the expenses incurred to generate them.
Which method should most Schedule C filers use?
Many small businesses without inventory use the cash method because it's simpler. However, there's a key rule. Unless you're a qualifying small business taxpayer, using that exception we just discussed.
The $30 million test.
Right. If your business involves selling merchandise inventory, you generally must use an accrual method, at least for your sales and purchases of inventory items. That's a critical distinction.
So inventory often forces the accrual method, unless you're small enough.
Correct. That small business exception allows qualifying taxpayers with inventory to use the cash method if they prefer, or to treat inventory as non-incidental supplies.
Can you change your accounting method once you've chosen one?
Generally, yes, but it's not automatic. If you want to change your overall method of accounting or the treatment of any material item, you usually need to get IRS consent by filing Form 3115, Application for Change in Accounting Method.
Form 3115. Sounds complicated.
It can be. Changing methods often requires calculating a Section 481A adjustment. That's basically a special calculation the IRS requires to prevent you from either duplicating income expenses or completely omitting income expenses when you switch from one method to another. It ensures a clean transition.
So the choice of accounting method isn't trivial. It impacts timing.
It significantly impacts the timing of when you recognize income and deductions each year. So it's important to pick a method that suits your business operations, apply it consistently, and properly manage any changes if needed.
Okay. Now, line G, material participation. This seems incredibly important, especially for how business losses are treated. We keep coming back to it. It's not just about showing up, is it? What exactly defines material participation in the eyes of the IRS?
You're absolutely right. It's about much more than just showing up or owning the business. Your level of participation is critical because, as we've discussed, it directly determines whether your business activity is considered passive or non-passive for tax purposes.
And that distinction matters most when there's a loss.
Primarily, yes. If you materially participate in the activity, generally any losses generated are considered non-passive, which means they can usually be deducted against your other non-passive income, like wages, in the current year, subject to the other limitations like at-risk rules.
But if you don't materially participate,
Then the activity is generally considered passive, and any losses are subject to those passive activity loss limitations we talked about, meaning they can usually only offset passive income, and the excess gets suspended and carried forward.
so what counts as participation?
The IRS defines participation as pretty much any work you do in connection with an activity in which you own an interest, as long as it's work typically done by owners and not just work done in an investor capacity to avoid loss limits.
Investor work doesn't usually count.
Generally not, unless you're directly involved in the day-to-day management or operations. Just reviewing financial statements or approving capital expenditures usually isn't enough on its own. Importantly, though, your spouse's participation does count as your participation, even if they don't own an interest in the activity or you file separate returns.
Okay. How do you prove material participation? Are there tests?
Yes, the IRS provides 7 specific tests for material participation. You only need to meet one of these tests for the year to be considered a material participant.
7 tests. Do we need to know all of them?
Probably not in detail for today, but the key ones generally boil down to your time commitment and level of involvement. For example, you materially participated if, 1, you participated for more than 500 hours during the year. That's the big, clear benchmark.
Over 500 hours.
Okay.
2. Your participation was substantially all the participation in the activity by all individuals, including non-owners, for the year.
So if you're basically the only one doing anything.
Right. 3. You participated for more than 100 hours, and that was at least as much as any other individual, including non-owners, participated.
More than 100 hours and nobody else did more.
Exactly. There are others involving significant participation activities adding up to over 500 hours, prior year's participation, participation in personal service activities, and a general facts and circumstances test, though that one is harder to rely on.
So the core insight for tax saving, especially if you might have a loss, is document your time and involvement. Keep contemporaneous records, logs, calendars, appointment books showing the hours you worked and what you did. Without proof of your active role, especially if you have a business loss, the IRS could challenge your material participation and reclassify the loss as passive.
Which could suspend your ability to claim that loss currently.
Precisely. This is why active involvement and having the documentation to prove it isn't just about running your business well. It's absolutely critical for protecting your ability to deduct losses for tax purposes. Understanding these tests can prevent potential disallowances.
That makes sense. Active involvement is key, and proving it is crucial. Speaking of proving things, record keeping is mentioned in Part 4, line 47 regarding vehicle expenses. But it applies everywhere. We all know it's important, but why is it so crucial for Schedule C, especially for certain expenses like car and truck?
Record keeping is, without exaggeration, paramount for Schedule C success. Think of it as the absolute bedrock supporting all your claim deductions if the IRS audits you.
They'll ask for proof.
They will absolutely ask for proof. And the burden of proof is on you, the taxpayer, to substantiate your income and expenses. The IRS has specific, often stringent record-keeping rules, especially for areas prone to abuse like travel, meals, and particularly car and truck expenses.
What kind of proof do they need for car expenses, for example?
For car expenses, whether using the actual or standard mileage method, you generally must have records proving the amount of each expense, if actual, the mileage for each business use, the date of the use, and the business purpose of the trip. A contemporaneous mileage log is highly recommended, almost essential.
Contemporaneous meaning recorded at the time, not recreated later.
Ideally, yes. Recorded at or near the time of the trip or expense. Without adequate records, receipts, logs, bank statements properly annotated, even legitimate deductions can be disallowed upon audit.
Which means you could end up owing more tax, plus potentially interest and penalties.
Exactly. So the good news is you don't need shoeboxes full of paper anymore, necessarily. You can maintain your required written evidence using electronic storage systems, digital records, scanned receipts, mileage tracking apps. These are fully acceptable, provided they meet certain IRS requirements for accuracy, retention, and accessibility.
So diligent record keeping isn't just about compliance.
It's a direct path to preserving your hard-earned tax savings. Your records are your evidence. Don't neglect them throughout the year.
Solid advice. Now, Line I asks if you made any payments in 2024 that would require you to file Forms 1099. What's the obligation here for business owners? And you mentioned an important update.
Yes. Line I is a simple yes-no question, but it reflects a significant compliance responsibility. If you, in the course of your trade or business, made certain types of payments to others during the year, you may have an obligation to file information returns, primarily Forms 1099 with the IRS, and furnish copies to the recipients.
What kind of payments trigger this?
The most common one for Schedule C filers is paying $600 or more to an independent contractor for services. That generally requires filing Form 1099 NAC, non-employee compensation.
Okay, $600 to a contractor means a 1099 NAC. What else?
Other common triggers include paying $600 or more in rent for office space, Form 1099 NAAC, or paying certain amounts of interest or royalties. There are many types of 1099s for different situations. Wages paid to employees, of course, require Form W-2, not 1099.
So, if you made any such payments, you check yes on Line I.
Correct. Checking yes acknowledges your potential filing requirement. And here's the important and impactful update for filings related to tax year 2023, filed in 24, and going forward. The electronic filing threshold for information returns has been lowered significantly.
Lowered how much?
The threshold is now 10 returns. That means if you are required to file a total of 10 or more information returns aggregating all types, like 1099s, W-2s, etc., in a calendar year, you are now generally required to e-file them with the IRS rather than filing paper copies.
Only 10. That used to be much higher, right?
Oh, it's much higher. It was 250 previously for most forms. This change to 10 returns impacts many more small businesses than before, so be aware of this lower e-filing requirement to avoid potential penalties for failing to file electronically when required.
Wow. 10 returns total triggers mandatory e-filing. That's a big change for small businesses to be aware of. Finally, for anyone listening who might be feeling a bit overwhelmed by all these details, where can they go for additional help or more detailed information? The IRS actually provides a lot of free resources, don't they?
They absolutely do, and these resources are genuinely invaluable. The IRS website, irs.gov, is packed with information. Specifically for Schedule C filers, I'd recommend irs.gov Schedule C. This is the landing page specifically for the form. You'll find the latest instructions, updates, and related links there.
Okay.
irs.gig, as mentioned, a great resource tailored for the tax situations of gig economy workers. irs.gov Small Biz. This links to the Small Business and Self-Employed Tax Center. It's an excellent hub covering a huge range of tax topics relevant to anyone running their own business.
Are there specific publications?
Yes, the IRS publishes detailed guides on many topics. Some key ones for Schedule C filers include Publication 334, Tax Guide for Small Business, a comprehensive overview. Publication 463, Travel, Gift, and Car Expenses, dives deep into those tricky areas. Publication 538, Accounting Periods and Methods, more detail on cash versus accrual, etc. Publication 587, Business Use of Your Home, the definitive guide for that deduction, covering both methods. Publication 925, Passive Activity and At-Risk Rules, explains those loss limitations in detail.
Wow, those sound incredibly useful.
They really are. These publications are like free mini textbooks written by the source. They provide much more detail and examples than we can cover here. They're invaluable for anyone looking to truly understand the intricacies and maximize their legitimate deductions.
Fantastic resources. Definitely worth checking out.
For sure, don't hesitate to use the free resources the IRS provides.
Wow, okay. We have covered a tremendous amount of ground today, haven't we?
We certainly have. Schedule C has a lot of layers.
It really does.
Aye.
From the foundational definition of what truly constitutes a business for Schedule C, all the way through to those incredibly specific deductions like the de minimis safe harbor and the nuanced two-pronged approach to home office expenses. We've really pulled back the curtain on how these tax instructions, when you understand them deeply, can be your ultimate guide to significant, legitimate tax savings line by line.
That's the hope.
So stepping back, what does this all mean for you, the listener, the small business owner, the self-employed professional tuning in?
Well, if we connect this to the bigger picture, I think it means that being well-informed about Schedule C isn't just about compliance, just checking boxes. It's really about empowerment.
Empowerment, how so?
Because every single line on Schedule C represents an opportunity to accurately reflect your business's true financial reality, yes, but also through diligent record-keeping and a proactive understanding of these rules and elections we've talked about, an opportunity to legally and strategically minimize your tax liability.
Using the rules to your advantage.
Yeah. Exactly. Knowledge, in this case, truly is financial power. It allows you to transform what often feels like this burdensome compliance task into what we said at the beginning, a powerful, proactive financial management strategy for your business.
I love that perspective. Turning tax filing from a chore into a strategy session. So here's a final thought to leave you with. Considering all these intricate details we've unpacked today, all these potential tax-saving strategies hidden within the lines of Schedule C, how might a more proactive, more detailed engagement with your business's financial data throughout the entire year, rather than just scrambling frantically at tax time, how might that unlock even more strategic tax efficiencies and maybe even fuel greater growth for your future?
That's a great question to ponder. Continuous financial awareness versus just year-end reporting.
We really encourage you to revisit your own business records with some of these insights in mind. Perhaps look at your expenses, your income, your assets through a fresh, maybe more tax-savvy lens based on our deep dive today.
Yeah.
You might be surprised what savings you uncover.